Although we don't have many FTSE 100 firms stepping up to the plate this week, a rash of results from mid and small cap stocks will be keeping us all busy. In addition, we have a couple of important central bank announcements to watch, namely the latest decisions on interest rates and quantitative easing, or QE, from the US Federal Reserve on Wednesday the 20th of September and the Bank of Japan on Thursday the 21st. The Bank of Japan is expected to leave its headline interest rate unchanged at minus 0.1%, yes, you heard me right, and leave its QE scheme on full tilt at 80 trillion yen a year, or around £560 billion a year. Remember, the UK's total QE scheme over the last 8 years has come to just £445 billion. Now, so far as the Fed's concerned, the market's putting a 0% chance on a rate rise and a 1% chance on a rate cut. So that means consensus is for no change at 1.25%. Now, the US Central Bank's guided to 3 rate hikes this year, and so far it's squeezed out 2, with this meeting and those in November and December to come. In fact, the market's putting only a 1 in 3 chance on a 3rd hike at December's meeting. So the US Central Bank is still tightening policy very, very slowly. This chart shows the headline Fed funds rate all the way back to 2007. Watch out also for any comments from Chair Janet Yellen on the US economy, because the Fed's due to update its growth and inflation forecasts, and also its QE scheme. The Fed has hinted it may start to withdraw stimulus soon, initially by $10 billion a month, rising to $50 billion a month within a year. Now remember, the Fed's balance sheet's gone from $900 billion to $4.5 trillion under QE, so at that rate it would take until 2023 or 2024 to neutralise all of the stimulus. Why does this matter? Well, this chart suggests that the cheap money provided by QE has helped provide liquidity that's flooded into stocks looking for a quick return. So there has to be a risk that the withdrawal of liquidity has the opposite effect. At the very least, we may need to see improved momentum in the US economy and American corporate earnings growth to take up any monetary policy slack and in turn justify current record highs or further upside in leading indices such as the Dow Jones Industrials and the S&P 500. This chart shows how the Fed could, in theory, start reducing its balance sheet, assuming it begins straight away. Now on the home front, we've got 5 FTSE 100 firms scheduled to offer comment on results or host meetings in the coming week. They include support services giant Babcock and B&Q and Screwfix owner Kingfisher on Wednesday the 20th, an analyst meeting at Johnson Matthey on the 21st, and full year results from sensors to scanners to medical equipment conglomerate Smiths Group on Friday the 22nd. However, the stock really capable of causing a fuss next week is global drinks firm Diageo, which hosts its annual general meeting on Wednesday the 20th of September, not least as the firm tends to put out a short trading update alongside the event. As we can see here, the shares have done well over the past 12 months, rising by more than a fifth to new all-time highs, buoyed by the strength of global brands such as Johnnie Walker, Captain Morgan and Smirnoff, the global trend towards liquor premiumisation, which gives Diageo pricing power, and a boost to earnings from a weaker pound. On top of all that, we've got Diageo's own efficiency drive, which is designed to further increase profit margins. Boss Ivan Menezes tends to offer only a short update ahead of the AGM, but watch for comment on 3 issues in particular. First, a target to generate trend mid-single-digit organic sales growth. Second, a plan to increase profit margins by 175 basis points, or 1.75 percentage points, over the 3 years to June 2019. And third, the ongoing £1.5 billion share buyback programme. Some investors may well lap that up, but it does look a little bit odd to be doing it now when the shares are at an all-time high. Beyond that trio, investors must then consider the stock's valuation. A forward price earnings ratio of 22 times is a big premium to the UK market, and a 2.6% yield represents a discount. So while investors are getting a quality and relatively predictable income stream, they're having to pay highly to access it. Whether you think those numbers represent value is something that only you can decide. Thank you for watching, and I look forward to seeing you next time.